Thanks for joining our Retail Shock Scenario Roundtable. As part of effective risk management, Fitch sometimes examines scenarios that lie well outside the consensus and that may in fact be considered extreme. This allows us to observe correlations and weaknesses under stress. So in this spirit, we applied a hypothetical stress that envisions Amazon increasing its apparel market share from 7 to 25% in just 3 years, thereby disrupting the retail sector. We want to be very clear, however, this is a purely hypothetical scenario and is not intended to call into question the assumptions underpinning Fitch's existing credit ratings or outlooks. Joining me today to discuss the findings are Monica Agarwal, Head of U.S. Retail, Stephen Marks, our Senior REITs Analyst, and Melissa Chi from our CMBS group. So thanks everyone for coming. So first question for Monica. Could you give us an overview or outlook on U.S. retail?
Sure, Bob. Department stores and specialty apparel retailers have been facing competitive threats for at least a decade. Consumers are seeking value-oriented retailers that offer attractive and acceptable quality merchandise, and therefore spending has been moving towards fast fashion retailers such as Zara and H&M, and off-price retailers such as TJ Maxx and Ross stores. In addition, we have seen apparel purchases move rapidly online, and that has put significant pressure on in-store sales. Companies are having to invest heavily in omni-channel platforms and also rationalize their physical footprints. As a result, we have seen decline in EBITDA margins and reduced cash flow. Having said all of that, we would still expect 70% of retail sales to be transacted in a physical store in 2020. We expect operationally and financially strong companies such as Nordstrom, Macy's, and Kohl's to maintain market share over time as they transition to omni-channel models, and they already have about 20% of their sales coming from the online platform.
Oh, okay, thanks. So in the hypothetical scenario, what happens to these companies' credit profiles?
Under the shock scenario, we would expect in-store industry apparel sales to decline by 50% over the next 3 years, with small or distressed retailers facing sharply elevated bankruptcy risk. We would expect the larger retailers to see revenue decline 20% and EBITDA decline 40%, and that would make it challenging for them to maintain their investment grade ratings.
Okay, thanks. Stephen, in the report we talk about sort of a two-pronged impact on REITs. One, anchor department stores leaving and inline stores. Could you explain to us how this plays out in the malls?
Right, we think that it does play out in two steps. First is the immediate net operating income impact from departing anchor stores and inline retailers that have exposure to apparel. And secondly is what we're calling the knock-on effect. And the knock-on effect strictly applies to inline tenants invoking their co-tenancy clauses or otherwise leaving centers because an anchor has left. And we envision that the net operating income loss from departing anchors is around 1%, and it's around 6% for the inline. But it's really the knock-on effect that's much more severe or much more impactful to companies' overall NOI. And that's because anchor tenants, whether or not they own the space or lease the space, drive significant traffic to the center. And so they're often included in co-tenancy clauses in inline tenants' leases, and a co-tenancy clause enables an inline retailer to renegotiate its lease or actually terminate its lease in the event of a departing anchor. And even if an inline tenant doesn't activate a co-tenancy clause, we still can envision a scenario whereby entire wings of malls close due to the departure of the anchor on that wing, and thus it would create significant inline vacancies. We estimate that the secondary impact could negatively impact NOI anywhere between 7% and 19%. So when you add the two steps together, we estimate that B malls, for instance, could have their NOI decline by around 25%, and an A mall like Assignment decline by about half of that, around 13%.
Okay. So with that being said, how important is openness of the capital markets for REITs, and how is that comparing to what's going on in the market right now?
Having consistent access to multiple forms of capital is an important element when we analyze companies' credit, particularly REITs. And right now that access to capital varies by the underlying asset class. For instance, we see that weaker retail formats such as B malls, less productive centers, don't have great access to the mortgage market. And recently, actually at the end of September, we revised the outlooks for both CBL and Washington Prime, both of whom primarily own B malls, to negative from stable, because our view that their access to the mortgage market in particular has diminished, and thus it does call into question the leverageability of their unencumbered pools.
Okay, thanks. All right, Melissa, so we heard a little bit about retailers and REITs. So with that information, how did you frame the CMBS shock scenario?
Sure, Bob. Retail property performance, especially for regional malls, has been an existing concern in CMBS since 2013. Within the hypothetical apparel shock, we focused on stressing and identifying those mid and lower tier regional mall loans in our deals. We view these properties to be most susceptible to a steep drop in property valuation, and by extension, lower recoveries and higher losses to the loans stemming from the retail shock. In order to distinguish asset quality, we categorize the individual malls in CMBS deals into 3 tiers based upon market location and position, sales performance, tenancy mix, and sponsorship quality. Loans secured by Tier 1 malls, which we view as highest quality, were assumed not to default, while those secured by Tier 2 and Tier 3 malls would default. In the shock, we also assumed CMBS special servicers would take title and liquidate an asset under a quick sale scenario, as opposed to a loan modification or an extension. Given a quick sale, low recovery prospects would result in significant losses to the loans, thereby impairing credit enhancement and negatively impacting ratings. In terms of ratings impact, retail-heavy CMBS deals with high concentrations in lower quality regional mall properties would be most sensitive to larger negative ratings movement, while those CMBS deals with lower mall exposure or where the exposure is limited to higher quality properties, those will experience more limited ratings migration.
So the shock scenario sounds pretty severe. How does it compare to your current expectations?
Well, in surveillance, for lower tier malls, we typically apply a cap rate at the highest end of our range of long-term historical averages, as well as higher cash flow stresses, such as in cases where co-tenancy clauses have been triggered, with declining occupancy, or with weakening sales performance. We do recognize that many of the regional mall loans in our portfolio still have relatively low LTVs as they were conservatively underwritten, so they are able to withstand very large cash flow stresses. So in those instances where we feel the mall may not be viable in the longer term, we will apply a loss assumption similar to the retail shock as a rating sensitivity scenario. Those rated classes heavily impacted by the scenario have already in many cases been assigned negative outlooks. On the new issuance side, we haven't seen many regional malls being contributed to new transactions, but we may apply an adjustment to the loan's probability of loss, often up to 100% to reflect riskier malls and also to reflect idiosyncratic risks.
Okay, interesting. Well, first I'd like to thank the 3 of you for joining me today, and thanks for all of you watching the Retail Roundtable.